so much for taking the time to speak with us this afternoon.
Oh, Michael, thank you so much for inviting me.
Absolutely. Why don't you tell us a little bit about yourself and about Fairway Independent Mortgage Corporation?
Gosh, there's so many things I could say. But I've been in mortgage lending for 21 years. I've been with Fairway Mortgage for 9 years. And I have a team of about 35 people who love helping clients get into not only a home of their dreams, but into the financial stability that real estate provides. The other 90% of us that can't afford over $100 million for a Marilyn Monroe print or a 1955 Mercedes-Benz, but we can afford a car, we can afford a house, and the house provides stability. And so that's what our team does every day. We just look for opportunities to help our clients enter into home ownership.
Fantastic. So the Fed just raised the benchmark rate by 75 basis points. What does that mean for ordinary people who are looking for a mortgage?
So everybody thinks that, and I got the calls, especially on the other side when the Fed rate was dropping them. I just heard that the Fed rate is 0. I want that interest rate. And I go, I want that interest rate too. It doesn't work that way. So the Fed is trying to impact inflation. Some would say that they're very late to the game. Some would say that they're trying to make up time. And I'm not going to debate whether or not I think he did the right thing or the wrong thing, but they're doing the thing now. And they've decided that they're going to attack inflation. I love the fact that they did a 75 BIP or 0.75% raise in the Fed rate, because it shows the intention of needing to corral inflation. So them raising the Fed rate 0.75%, though, doesn't mean our interest rates on a mortgage are going to go up 0.75%. You have to think of the Fed rate and mortgage rates more like cousins. They operate similarly, but they certainly don't always move at the same time or even in the same direction. The 30-year fixed is more heavily tied to the 10-year Treasury yield, and that we're more like sisters. Those were going to move a little bit closer, lock in step. So the Fed they raised their Fed rate. What it really impacts for those people who are in home ownership in the real estate industry, it impacts HELOCs, home equity lines of credit, dollar for dollar, point for point. So those home equity lines of credit are based on the prime rate. They're usually prime +1, prime +0.5, and that prime rate goes up lock and step with the Fed rate. So everybody that's got a HELOC that's paying interest only, those monthly payments just went up, making it a little bit harder to pay down that HELOC quickly. It also impacts things like car loans and consumer debt, credit card interest rates, those things that are going to impact consumer debt when the cost of everything is going up anyway. So not only is it costing you more to buy that thing, it's now going to cost you more to keep that thing on your credit card. So definitely something that's impacting affordability for a home because it's affecting debt to income ratio or simply the ability to budget a monthly payment. But it doesn't directly impact the 30-year fixed, but is a measure of the overall economy.
Okay, great. So what are some of the options or programs available to buyers who maybe can't afford a 6% plus interest rate? What are some of the risks and benefits associated with the different options that are out there?
Absolutely. It's hard to stomach 6%, right? It's hard to stomach it when we've been seeing 2.625 and 3 and 3.5 and 4 for what seems like decades, but was just a couple of years. And so we've gotten used to that and we want to hold on to that. But realistically, 7% is really like the historic average. So we're still sitting with a really good interest rate. It just doesn't feel like it because I go back to what we've just had and had the blessing of having. So sure. 75% of homeowners are locked in under or at 4%. So there's a lot of people that are going to hang on to those for a long time. But for those people that are getting in now for the first time, what I'm trying to talk to them about is the fact that this higher interest rate is now giving them the ability to get under contract. Whereas there was so much demand, now we can use some of those other programs that we hadn't been able to use for the last 2 years, like the down payment assistance programs, VA programs, and FHA, which were really kind of shunned over the last 2 years. We're able to use those again. So we've got great access to down payment assistance programs. We also have programs from Fannie Mae and Freddie Mac that simply based on your income, you might qualify for a slightly better interest rate and slightly better mortgage insurance, which absolutely helps with the monthly payment. So first-time home buyers now have options that they didn't before because they couldn't get into the house at all.
Sure.
Because they couldn't win the over ask, as far as bidding over ask and that whole situation. So those are some of the programs that are just simply available that have always been available. There are grants along with down payment assistance that you can look at taking advantage of. I know that Fannie Mae and Freddie Mac are both increasing their income limits for those additional programs that allow for slightly better interest rates and mortgage insurance. You should definitely talk to your lender about Home Ready and Home Possible. And we're also seeing more renovation loans. So maybe it's a home that costs less because that budget is tight with the higher interest rate, but it needs love. And so if you can get that home where you might not have been able to before, now you might be able to get a renovation loan offer approved. The closing is going to take closer to 45 days versus 30. But you can make the kitchen the way you want it. You can add an extra bedroom, or you can add an auxiliary dwelling unit in the backyard for additional rental income that can help offset that mortgage payment. So getting creative is really the key to this kind of market and these rising interest rates.
Absolutely. Yeah, no, those are really great ideas. What does the mortgage industry look like right now? And what do you foresee coming over the horizon? What can buyers do to prepare now?
So the mortgage industry is consolidating. There's a lot of lenders out there that had been taking they've been taking advantage of the opportunity of lower interest rates and creating refinance shops or the focus on refinances. So some of those lenders that maybe you worked with last time, they might have left the industry. So now the mortgage industry is consolidating. Having said that, the programs available is actually expanding. So we're seeing more non-QM products like bank statement loans or DSCR, which allows you to purchase an investment property using just the income on that property, not your W-2 or your employment income. So it's opening up in that regard. Jumbo loans are becoming a little bit more widely available. We've got jumbo loans that go up to 96.5% loan to value, jumbo loans that go up to 55% debt to income. I mean, these are expanded guidelines that hadn't been available, especially at the beginning of COVID, when everybody was getting tighter on guideline restrictions because they just weren't sure where the market was headed. Well, now with less volume, a lot of lenders are getting more creative and opening up additional lending opportunities. Now I'd be re-asking the question, what do I approve for? What does my debt to income ratio and my criteria allow me to purchase? So as a buyer, I would be looking at this as an opportunity, respecting the fact that I know interest rates are higher, but you can't refinance a purchase price. And we know purchase prices and home values continue long-term to always go up, but I can refinance an interest rate. So when interest rates do go down, when we do hit a recession, you'll have the opportunity to lower that monthly payment into a lower budget amount that fits for your lifestyle. I wouldn't say go past that. I'd say stay within your budget, but now might be the time to talk to a creative lender that can maybe look at some of those expanded guidelines, whereas you might have been told before, now you'd be told yes.
Great. Awesome. Nicole, thank you so much for joining us today. If buyers wanted to reach out to you or your team, how would they do that?
So we are all over social. Hopefully you've seen us, but you can definitely go to the ruethteam.com, and my last name has an E in it, RUETH. So the ruethteam.com is where you can get in touch with us, learn a little bit more about us. And of course, we're on Facebook and Instagram and YouTube. We have a great YouTube channel where we talk about different topics relevant to both lending and investing. Every Wednesday, we put out a new video. And then, of course, we do our Tuesday lives on Facebook talking about what's happening right now that we need to all be aware of.
Awesome. Thanks so much again for joining us, everybody. Really appreciate the time, Nicole. Thanks for joining us, and hopefully we'll be in touch with you soon.
Sounds fantastic, Michael. Thank you so much.
All right. Thank you.